website. If you have questions to drop in the chat, that's great. If you have submitted questions already, we have those available. But let me let Julia introduce herself as my co-host with this conversation with Dan.
Thank you, Elias. Hello, everyone. My name is Julia. I'm a contributing editor to Ownership Matters newsletter. I'm an assistant law professor in Brazil and have been researching cooperatives, recently finished my doctorate, and I've been very interested in the employee ownership movement in the United States. And I've met Dan during a case study, and I've been following his work since then, and I'm really excited for this conversation. Thank you for joining us.
Great. Let's see, Dan, I'll read a little quick bio and then give us your opening thoughts before we jump into the questions. Dan Fireside is the founder of Uncommon Capital Solutions. He is a board director at Namaste Solar. He is an advisor to the Main Street Phoenix project, and he is a fundraising coordinator for Downtown Crenshaw. He was also the capital coordinator for Equal Exchange for just under 11 years. So that's a pretty interesting resume.
A little bit crazy, actually. And my latest client is called Local Code, which is focused right now on a Black-led real estate development project in Kansas City.
Wow.
Sort of inspired by the same issues motivating the folks in Los Angeles.
Yeah, yeah, all right. Let's see, Julia, do you have an opening question for Dan? And we'll go back and forth.
Oh, I think you can go back and forth, yes. You like me to start?
All right, since I started by mentioning something about political democracy, let me ask Dan about his path to movement fundraising. It did not include studying business or finance, which is probably a great thing. Instead, you were involved in politics early on. And so my question is, how important do you think it is for people doing this work to have some kind of political framework?
I think the political framework is maybe the most important thing. Yeah. You know, we're all given a political framework and develop one, and you're definitely, you know, immersed and swimming in the ideology of the dominant political framework if you go to business school or just have a traditional finance career, but you may not be aware of it. And you know, I distinctly remember when I was interviewing for the capital job at Equal, that the co-president, Rob Everts, you know, I was talking with him. I was one of the finalists, and I said, you know, I'm bringing a lot here. I'd actually written my master's thesis. I did get a master's in city and regional planning at Cornell, and you know, I had done other stuff since then, but I was like, I don't have a background in private equity and, you know, preferred stock and all this. He said, well, in our experience, the people who came from that background, who didn't have the political orientation, ended up being the worst people that they had, because they were just sort of stuck in, this is how you do these deals. This is what the investors are interested in. This is, you know, everyone's motivation is maximizing their advantage. And they had a hard time unlearning it, and also really speaking to the real motivations of the people who wanted to use money for a different purpose. And he said the people who came with the political orientation first, you know, if they're lucky, they figure out the crazy system, the alternative system that Equal built and what the needs are of similar organizations, and they're the ones who tend to succeed. So it's like not a guarantee that it would work out for me, but they took a shot, and I was able to, you know, raise, I think, somewhere between like $15 and $17 million over that period of time, and manage, you know, an investor community of over 500 investors, and help out a lot of other co-ops and mission-driven companies as part of that role. And yeah, I have to say, often the most effective thing I did when I was speaking to a prospective investor or a current one who I hadn't met, and they would call up to just change their address instead of just like here's the secretary and we'll input your data. I would just have a conversation with them and try to find out why did you invest in this, and people are never asked that. You have mutual funds or this and that. It's like, to make money, but this is a weird thing. It's different. Why are we having this conversation? If it's about this potential return and here are all the financial, it's like we can go through all that. There are answers to that. But if that's your primary focus and what this is going to live or die on, then you know what? Put it in a mutual fund. If you can sort of shake your head out of that other framework and go, let's try to do something much more interesting and important. And by the end of, what I want people to do isn't go, oh, here's, if everything goes right, you might make 5%. I want them to go, this is the coolest thing I've ever put my money into. And I don't, care if I make money or lose money, that I will feel amazing about it. And I feel like excited that I have this opportunity to do something different. And it doesn't matter if it's like, a few $1,000s or a much more substantial sum. And so that was really my goal with every sort of engagement, to bring it back to this human level. And to do that, you need to engage, figure out where people are coming from, and you need that political analysis to sort of paint the picture of, we're not going to change the world with this one company or this one investment, but it's part of a larger movement.
So your role in that job led you to the realization there was such a thing as a social investor, right? And there were quite a few of them, and they were more committed than you imagined. Am I reading you right there?
Oh, actually, it was more the other way. The people who are often self-styled social investors are the ones that are the most trouble. The polite way is that we came up with, the shorthand was, people who wanted to make a killing and sleep well at night were the ones who were the first ones to say, I'm a social investor.
Yeah, I see.
I want you to do right by the workers and the planet and everything, and I want to make the same returns I was making with Evil Corp 101. And we were like, here's the problem. The reason they're making a killing is because of all the externalities, that they've pushed onto society, the negative externalities and all the social bads. And if you're actually going to do right by all these stakeholders, that's going to cut into profits. And you should realize that, and you should actually feel good about that. So part of what I was doing was really sort of saying, like, look, that we have to put a value on the social return. And it's not enough to just sort of say, okay, we filled out some form and we get a 79 and on some scale that you don't understand. To really make it tangible, it's going to be different for everybody. So, for Equal Change, which is a national company, I was, and that worked globally, I put a lot of time and energy into it. Sort of had to argue for it around the annual report, because that was where we could tell the stories. This isn't okay. The theme was generally, we made some money, we sold a lot of stuff, and you got a return. And if we were a normal company, that'd be in this story. Maybe we'd tell you we donated some money, but that's the least interesting thing we did in a certain way. It was really hard, but here's all the stuff that doesn't show up in the balance sheet. Here's the grant we got to support farmers who are facing, changing climate and they can't move their coffee farm, and how they're dealing with collapsing governments and all the other work and the co-op and internal democracy, and really painting those pictures. And I would have to sort of battle for it because the company was like, hey, this doesn't sell more coffee. We gotta, our design team has to make the new package for the chocolate bars. And I was like, it's like, this is part of the social return. This is how we can pay people, a 5% return or maybe less when they could be making more money investing in Starbucks,
Mhm.
but keeps them hooked in and tells a story. And I got a lot of feedback on those reports, so I know people were actually reading them. I like to stick in a typo every once in a while, and
Great.
hear
Good
back.
stuff.
Yeah, no, but then it's funny. It's like, I think there's a lot of people who don't think of themselves as social investors, but you know, my personal view is, you know, the ESG, SRI, you know, ethical mutual fund is so overblown in one part, but really almost scandalous in another, because it shows two things. One, that there's a great demand for it. There are a lot of people who are willing to shift a bunch of their money into this idea that their investments are at least not doing evil and hopefully doing some good. But you look under the hood of these things, you know, if you have one of these mutual funds, look at what they're actually invested in. And it's the big tech stocks, you know, Google and Facebook and, or Meta and, you know, whatever they're calling themselves, Alphabet, and, you know, a bunch of drug companies. And you're like, this isn't what I had in mind. You know, Comcast is up there. I don't know, all these, you're like, maybe they've worked out some metric. You know, Wells Fargo used to top all these lists. How did that happen? So the real change happens off the public markets. And there's a challenge there because there's all sorts of regulations that make it hard for investors to invest and for companies to offer these opportunities to people who are not super wealthy. And that takes a lot more work, and it takes a certain, you know, it might be more risky or it might not. I mean, the stock market's been plummeting because of factors way beyond anyone's control, you know. So you can lose money in the public markets. You can,
Sure.
there's nothing stopping us from blowing all our money at the casino. But the government has decided that it's going to be very difficult for you to put $100 into a company you love.
I'm glad that this is the topic today. I'm sorry to interrupt you.
Yeah, no, stop me. So,
you know, particularly today with the Ukraine attack, I have already, like less than 24 hours later, I have already came across a bunch of news like defense company stocks to buy as the Russian-Ukraine crisis heat up. And this is the market we are inserted. I want to remind, right? And I'm glad this is the theme of our conversation today as a coincidence, so we can really reflect upon these issues. And very connected to your answer, just want to emphasize there is this common perception that outside investors are antithetical to the cooperative model. And many members avoid accessing this type of external capital for fear of losing control over, you know, the future of their organization. So what would you say? And also, allow me to already ask something regarding your answer. You said about making the social impact more tangible. And this is, for me, one of the main challenges, because certain things we can just, you know, bring into a financial metric. We can translate that into a language that investors are going to understand. And believe it or not, I had a conversation with a person who asked, like, why preserving the Amazon rainforest? Why we don't plant soy, such as a very good commodity that really brings value? What is the value of a living tree? How can you possibly compute the value of a living tree? So I think those are the questions that are very close to our hearts with the cooperative movement and the solidarity economy. So I'd like to hear your thoughts on that, Dan, if you can elaborate.
It's a challenge, and I think it's different for every company. I mean, my personal bias is I'm very suspicious of metrics. You know, there's this idea that you can measure everything, and if we could just quantify it all, that will give us this magic understanding. And the reality is, you know, especially with these voluntary systems, you know, you're only going to join them if they'll make your numbers look good. And so there's the sort of conflict of interest there that the people designing the systems need more clients, and so they're not going to make a system that is going to make a lot of companies look bad. And there isn't really the capacity to, audit everybody. And, it's like, what is the value of a company being a worker cooperative versus being an ESOP, employee stock own program, versus a really nice, guy like the founder of Zappos, who really seemed to care about his customers and seemed to, and the workers, and, was a super awesome guy. And, like, do you get a number? Like, okay, he gets a 4, and, I don't know, the ESOP gets a 6 and a co-op gets a 7. Usually, actually, the co-op doesn't get any, bonus points for that. Like the metrics don't really speak to, like it's 100 times harder to start a worker co-op and have it, get to a certain scale and actually do all the democracy. And you're closing the whole business down for all company meetings where they're voting on, the board of directors. It's like there are serious costs, and it's not the most efficient. And it's actually sort of planned inefficiency. Like Equal Exchange, they didn't do graveyard shifts. It would have been much more, wise to run the coffee roasters 24/7. But they said, look, graveyard shifts are really bad for people, getting them off their circadian rhythm and everything. And also, then we're going to have a whole ghost workforce that isn't able to participate in all the other democratic things. They can't engage with the other workers, and we're not going to do it. And that was a conscious decision. They don't get points on some scale. And then, like, if you read, I always think about like the wine ratings, the magic numbers, anything 90 and above. And you talk to actual professionals, there's no difference between an 89 and a 91, or an 89, or even a 80 and something. It's, it's incredibly subjective, but, we're tuned to give this sort of magical properties to numbers. Well, a 90 has to be better than an 89. Somebody went through that went through something that I don't understand, and therefore this number holds some significance. And I mean, so you get to, the reality is the things that are valuable, they're much more qualitative. And not to say that you shouldn't try to figure out if you're actually achieving your goals, but the goals are going to be different for each company. One case in point is like Equal got sort of sidelined by the whole local food movement, which is like, everyone was supporting it and it was a great thing, but it doesn't apply to coffee. We were told, like, people on the West Coast, some stores were like, look, if you can't have a local roaster, we're going to have to cut your coffee. We're like, look, if we roast the coffee, it loses volume. It's actually, we're shipping less. We're reducing our carbon footprint if we roast it all in Massachusetts and ship it by train out to the West Coast. And you're saying we should ship the raw coffee and hire, a non-co-op roaster out on the West Coast so that we can claim that it's local, when, except for Hawaii and Puerto Rico, there is no local coffee in the US. They said, nope, customers demand local. So we actually had to hire a toll roaster in Washington State to roast our coffee that we, got delivered in the port in New Jersey and shipped it out to the West Coast. And the store slapped their local label, which had a map of California, Oregon, Washington, and Nevada. That was what they considered to be local within, 1,000-mile radius. And we're just like, this is absurd, but it fit these metrics that worked for certain companies and didn't for others. So I'm very suspicious, like, of these sort of simple, seemingly simple tools, if where the tool becomes the focus instead of the outcome. And more sustainable food systems and lowered carbon footprint, or whatever it is that you're trying to achieve, it gets lost in these imperfect models. And we need to be careful about getting sucked into that, because the big players can always win.
Well, that's good. I want to ask you a slightly wonky question, but might be very relevant to a number of people on the call here about co-op financing. And what I learned from you in our interview about your discovery of, or your co-invention of, I should say, the non-voting stockholder.
Mm-hmm.
So your story about how you came to this concept and what it took to kind of get it through and then realize it needed to be a real thing is kind of fascinating. Could you play back a little bit of that discovery and what you mean by the term non-voting stockholder and what it implies?
Yeah. So the creation of it at Equal Exchange is really Michael Rosine, one of the three co-founders of Equal, and Clark Arrington, an amazing co-op lawyer who was just inducted into the Co-op Hall of Fame, sort of came up with hammered it out on their own. So,
I see.
Back in the early days when Equal was founded in '86, there was no social businesses and things like that. They had a very hard time raising the capital. They got nickels and dimes from their friends and families, got off the ground, but part of their model was to pre-purchase the coffee from the farmers, from the farmer co-ops. Normally, the farmer co-ops have to hang on to all their inventory and only sell it when coffee companies want to buy it, or they sell it to brokers at a huge discount. The fair trade model said, no, we're going to sign a contract 6 months before the harvest. As soon as you're ready to ship it, we'll buy the whole year's supply, and you can get credit in that interim, and we'll pay it as soon as you put it on the boat, and not 90 days later, which is the norm. So that's great for the farmer groups, really shifts that power dynamic, but it created a capital problem for the company, where instead of having a just-in-time low inventory or buying, hedging on the futures markets, you had a year's supply of coffee from all these different countries sitting in your warehouse, and you can store coffee, but and they paid very high prices for it. But then their growth was limited by their ability to, keep increasing their inventory. And banks said, we don't know what a co-op is, and we don't know how to value your inventory, because just because you overpaid for it doesn't, and you went under, we'd be stuck with a bunch of green coffee, and we got to sell it for the market rate at a discount. So, and outside investors were like, hey, you guys, we want seats on the board, and how are we going to flip this company in 5 years? And they said, no, we want to be a worker co-op. So they had this conundrum that usually makes most worker co-ops stay very small. They're scrambling for their nickels and dimes, but and small can be fine. But if you want to grow, how do you get access to that growth capital that doesn't undermine the worker control of the company? So what they came up with was using preferred stock, saying non-voting preferred stock. And since they had put in clauses in the bylaws that prevented the company from ever selling, so there's no exit and no exit event, they said, well, we're not going to do quarterly valuations. Normally, you put money in a company and they say, okay, what would an outside buyer pay for this? And we'll change the stock price every quarter, and they're expensive and a waste of time. They said, forget that. We're just going to pick a number here. Arbitrary fixed price for the stock has no relation to the value of the company. Buy it, you have to hold on to it for at least 5 years, which happens to be, as I knew from my research, the amount of time it takes for a new coffee seedling to become a fully mature coffee tree. So a nice, metaphor there. And it doesn't change in value, but it pays a dividend every year, a non-cumulative, non-guaranteed dividend that's between 0 and 8% with a target of 5. And then we would say that rate is decided by the board of directors with, based on recommendations by the management and the capital coordinator, saying, sort of stakeholder balancing. How are we doing? We would look after the year closed. How is the company doing? Did we make a bunch of profits? Are we doing okay by the workers, by the farmers, by the company, by the planet? And if everything was within target, we'd pay 5%. If it was a little worse, if there's a pandemic or a war in Ukraine, or we can't get the coffee shipped in time, you might get 2 or 3%. If it's a gangbuster year, we might give you 8. But what's beautiful is the investors we had, if we ever offered to pay them 10% a year, they would get very upset. They would say, wait a second, who is this? Who is our profit coming out of? Are you underpaying the workers? Are we not, are we exploiting the farmers? And you'd be shocked. I've heard from so many other mission-driven entrepreneurs who try to give a similar pitch to social investors, and the investors go, well, if you just paid the farmers a little less, you could double the return to the investors. I mean, and they're like, wait a second, we're at the social impact conference and this is your framework, is let's screw the farmers.
Yeah.
So, or the, whatever, candle makers or whoever it is. I've just heard that versions of that story from so many people. So Equal really pioneered the use of this. Organic Valley came up with a similar program, and they're a farmer cooperative. When I started, there were almost no other companies using this model. We were very open with sharing our legal documents and sort of helping create the whole ecosystem of investors and financial advisors and lawyers, and making it more normal with the rise of equity crowdfunding that sort of helped. And it's becoming a little better understood, but it's still not mainstream yet. But it's a very powerful tool where it's basically a form of debt, but it counts as equity. And it doesn't give up control of the company and doesn't put the mission at the mercy of profit maximizers.
Yep. I know we got some people here that have some questions forming in their minds.
And if people want to share as well, I don't need to.
Yeah.
I'm not the only one who knows stuff.
Anybody burning with a question right now, raise your hand or whatever you like. Unmute yourself. Julia, please.
Thanks. Yeah. Well, so I'm interested in how Equal Exchange and those investors found each other, the ones who got it. Right.
That's the trick. No, I remember when I was in that interview, that final interview, and I was like, oh boy, I was looking at your coffee packages. You don't mention anything about this, and it's not on your website, and let's blast it everywhere. And they said, well, that's illegal, and we'd either go to jail or have to, give the money back. I was like, okay, wait, so how do I find the investors? And they're like, it's kind of crazy, but you'll see. And, so what's funny is you can't, now with direct public offerings and some of the crowdfunding, you can actually go directly to the public and advertise. And that is a huge advantage. But there are major limitations when you choose those routes. Like okay, you can go to the public, but you can only raise X amount, which might be way too low. And you might end up with 1,000 investors and you're a small company. And then unlike a fundraising thing where, okay, you send them a fundraising letter, it's like you're actually in a whole legal situation where you have to do all sorts of reporting and compliance, and you don't want 1,000 investors. So, crowdfunding is not a panacea. And so a lot of it is this sort of private hunting around where you can't publicly advertise. So it is a tricky thing. I go to a lot of conferences, do a lot of networking. As you can see, I'm very chatty. So I'm also very, open to helping others. And I think in the cooperative world, that's like super helpful. So, I don't want you know, as an equal, I didn't want someone to put their life savings in equal. I wanted them to give us a chunk of it. And then, hey, what else is out there? You know, equal could fail. Any company can fail. And I wanted them to, you know, support a whole bunch of other places. So I would often suggest like, hey, here's some other company doing something cool in an earlier stage. Throw some money to them. And part of it too was also, like I said, people would call up to change their, you know, their address, and I would engage in a conversation and find out what their motivation were. Oh, we had a farm, you know, my dad had a farm, we retired, I got a chunk of money, I don't really need to make any more. I really want to support, you know, farmers and organic farm. You know, I was like, well, I was just talking to these folks up in Maine who are, you know, doing a organic farm distribution network, and they're trying to raise $1 million, and they'd be, oh, that's so cool. So but if I had just answered the phone and changed their address, I wouldn't have known that, and we wouldn't have had those conversations. So it's really like getting away from this kind of super digital, impersonal mass communication level to relationship building.
Yep.
So, you know, I've built up a sort of network of people that I know who ask me, what else is out there? What else is out there? And I kind of, you know, I don't flood them with everything. I know, oh, these people like this region, or women entrepreneurs, or Black, you know, whatever their hook is. And conferences, things like that. It's also like building on the networks and people that you have. So a lot of the initial investors for Equal came from faith-based organizations that were sort of had given some grants and loans to Equal early on, because they supported the work they were doing. And some of them heard about it and said, hey, is there a way we could actually shift some of our church endowment to we loan you a bigger amount of money? And so, and again, you know, there's a trade-off. It was really complicated. We had like 30 different small institutions that were loaning us money, and they all, you know, their loans all had different interest rates, and they all had, some of them had different reporting requirements and different due dates. And it's a lot easier to have one bank, you know, just does automatic deductions, and you have your loan manager, and they take you out to lunch once a year, and you just deal with that. So there are trade-offs, you know, is like they needed me to manage the 500 investors. And so it's, if you're going down that route, it's being able to dedicate time and energy, you know, to that reporting and that realizing that social value, and then it works. I mean, I don't know, maybe I'm especially good at it and it works better for me, but I'm not, I hope it's much more universal than that.
Yeah.
And I think it's just more about like storytelling, and also letting people know that it's an opportunity. If you love a company and they've never told you that you could, you know, they're privately held, that you could possibly put in $1,000 or 10,000 or, you know, more, you would never think to ask. If they go, hey, we're looking to build our company from people who love us.
So not to turn this into just you know, dialogue, but that does make me like, I wonder if you could formalize that informal kind of brokering role that you're playing, and if there could be an entity to kind of consolidate and channel.
Well, that's great. It would, I don't know if that would give me a job security or put me out of a job. But I mean, what's tricky is, you know, the securities laws make it so that I can't just have like a website, like, hey, tell me all the cool things that are out there. I can tell you the ones that have gone through the hoops to be publicly, you know, listed, but I'm not allowed to put the ones that aren't. The closest thing we have to what you're talking about are financial advisors. And there's a really, you know, tiny sliver. There's like a very small sliver that have any idea what ESG, SRI, social stuff is. And 99% of them will just dump you in a couple of mutual funds and say, we're done with it. There's, you know, a couple dozen in the country who I call them hippies who are good with money. You know, who are still hippies, like the good ones who were like, they weren't out to make zillions, but they were good with the money and figured out the business stuff. And people said, hey, can you invest my money? And they were like, okay. And they built up a clientele. And there's a couple of, single advisory firms and a couple of larger ones, like Natural Investments is really the key one, but there's some other revalue investing and some other ones out there. It's really a tiny handful at this point, but they've been cultivating their clientele, saying, hey, shift some of your money into this. This is, if you're signing up with us, this is what we're into. They work, they just charge a flat fee of assets under management, so they don't get commissions from the stock they're selling. And those are the people that, like, they're lovely to work with. They come and they're like, okay, yeah, we need to do the due diligence on the financials, but they want to hear about all the social stuff and really make sure that it's real and not BS. And when you're doing that stuff, it's the relief that people have when they're like, yes, you get it. You're bringing me these investors. So those are our key folks, and we need more of them. And we need more people with some money to invest to sign up with them.
Just a quick note on that, Dan. We're thinking of doing an article on sort of a new generation of money coaches. Mm-hmm. It's what you're describing. I've also run into. It's really amazing. It's not a big number, but there are people that clearly are involved in helping people with assets repurpose their portfolios and think very differently. And it's just remarkable how far it has already gone. So it's a really interesting phenomenon. Anybody else got a question they want to jump in with here as we're getting? Micah.
I have a question. I'm sorry.
Sure.
I'll go quickly. I just wanted to add something.
Sure.
It's Mika from NC3.
Mika.
Yeah, no problem. And I just wanted to say on that conversation, something that we're excited about at NC3 is the rise and, increased adoption of a model that we broadly call community investment funds. So Kachua Impact Fund is a cooperative that I'm part of that I would put in that category. Boston Impact Initiative is well known. And we, especially the folks on my board, are very intimately familiar with all the issues that those funds have, particularly because there's just not the right exemptions from the 1940 Investment Company Act to make it easy and to make it something where you can actually grow your wealth a little bit. But we're hoping that with increased movement and increased interest around those, we can build a case to the SEC to create a different exemption and a clearer structure around community investment funds to make that something that you can easily put your money in. And that could be a #1 stop for cooperatives without having to manage 500 individual investors.
Super.
Yeah.
Super.
And I want to mention, Jose Luis is here, hola, CDFIs and are essential part of this ecosystem, although not all CDFIs are equal. Right. They're the ones that there's just a great, I've just heard from so many entrepreneurs and people, trying to deal with them, that some of them are a nightmare and very parochial. The ones like Leaf and Co-op Fund New England, Shared Capital, Seed Commons, just to name a few, are really mission driven and realize that you need a mix of not just money, but philanthropic funds and technical assistance to help people, and are really have that larger vision of employee ownership. Kachua is a great one. I helped Namaste Solar convert to being a worker cooperative, and they elected me to their board. We've done a bunch of fun raises, and they've spun off so many beautiful cooperative side projects, as Julia knows. One of them being the Kachua Fund. But all of these things, they're dealing with crazy regulations. So it's wonderful to hear, Mika. We should definitely touch base. I'd love to hear more about all the work you're doing.
I want to ask Min Sun to come in because I suspect she may have a question for you. Hi, Min Sun.
Yeah, hi. So I'm with the Drivers Co-op in New York, and our goal right now is to
Oh,
expand to.
rock on.
Oh, you cannot see it here?
Yeah.
Yes. No, we're just
I was-
cheering you.
Oh,
Again,
oh,
high
okay.
five, high five.
We
Okay,
love
I'm
Drivers
sorry,
Co-op.
Yeah, we love
Okay.
drivers co-op.
Yeah. So so my job is to create the Drivers Co-op in different cities, including different countries. And one of the biggest agony is fund capital. It's so many cities, they want to actually create a drivers co-op like in New York, but when it comes to raising funding, it's a tremendous challenge. We did have capital crowdfunding. We raised about $1.5 million, but we actually really need about $5 million. So our agony in this way, we could actually start another cooperatives in different cities, Boston, Denver, Medicine. So we are in connections with different cities, and also Brazil and Russia and different countries as well. So we need a significant fundraising. What will be your sort of suggestions as to, we are trying everything, but still, funding is the most difficult part. What would you suggest that we do to find more socially responsible investors? With the crowdfunding, actually we have about like 1,500 investors, but actually the amount that they actually invest was not that much. There were only a few small investors with the big money, but actually the rest of the money is just normal people's money like us.
Yep.
So what would you suggest that we'll go about? We are looking at different kind of methods right now.
Well, there isn't like a quick and easy answer. It depends in part on what kind of return you can pay, what kind of risk you're talking about, what the time horizon is. And once and that will lead you, a lot of those questions will lead you to like, what is a sustainable return? And I'm a very big believer in non-cumulative returns, where you're not guaranteeing, a fixed return, because, I don't get that in a mutual fund or in any stock in the stock market. No one's guaranteeing me anything. And I don't think we should be giving this special privilege to the outside investors that like you have no risk. If you're joining in, there's some risk, but I always try to say, we should be able to offer these things that if you made money or lost money, either way, you'll feel good about it. And you can't say that about most things that you invest in. And too many companies get, they have a couple of bad years and they have these cumulative returns that are adding up on their books, and then they get back in the black and they have this overhang and they can't pay patronage, they can't invest. And so, you got to design a product that works for you, that works for the business, and that's really in the ultimate interest of the investor too. Then to sort of figure out, okay, do you want another 1,000 investors, or, are you at a place where you can get some institutions to support you? It's not a quick thing. Like I sometimes I have companies that I think should be slam dunks and just everyone will be super excited about it, and I can't get people interested. And other ones that I thought were, long shots, it's just the right moment, the stars align. So it's sort of looking at that, figuring out what your hook is, what your message is, who you can appeal to. A lot of it kind of snowballs. You get a couple of the people that are in your network that are just really excited, and they have family and friends, and they make the introductions. I mean, I think it's really getting, I come back over and over to getting out of this transactional relationship. If they just gave you some money and you just send them a check and a statement every year, that's the same as every other investment they have. And that's not why they invested. That's not why you went to the trouble to find them. And you need to make this a relationship. And once it is, it brings in all sorts of benefits. I mean, I helped bring someone to support a project. He's an architect and planner in Massachusetts, and he supported this amazing project in Baltimore, and where they bought a property, and he was like, is it LEED certified? And they're like, yeah, we were thinking about it. It's like, you know, like he put in some money, but he was like, I will volunteer my time to help you get the LEED certification and be your consultant for free. And I was like, you know, that's not the normal relationship. I don't think he offers that to, you know, any company he invests in. But he feels like he bought into the mission. And so, you know, and he'll ask his friends, like, hey, this is a really cool thing, or colleagues, you know, let's support this. So it's figuring out what your strengths are, what relationships you have that you can build on. You know, it's helpful to have an outside consultant, because it's like, I'm out there in the field, like having these conversations with different funding agencies and funding networks, and finding out what their priorities are, what their cycles are, what their appetite is. And, you know, you only need to do this every once in a while. And so it can save you a lot of time and trouble to find someone who's sort of like doing that all the time. You can also do it yourself. And it's just sort of following up on all those phone calls and emails and people who are interested, and kind of doing some research on the people who have already invested. Maybe some of them actually have a lot more capacity than you realize. And so it's finding that out. But the biggest thing is, if you don't ask people, they're not going to give to you. They're not going to invest. You know, maybe they do, but you'll have a lot more success when you put the word out, and not just, you don't have to feel like you're begging. You're saying, hey, here's a wonderful opportunity. We're going to do all the hard work. And you get to feel great by, you know, shifting some part of your money into supporting this. And we're going to make you understand that you've had a real impact. So I would need to sort of think through, you know, who are the likely candidates, but there are definitely some out there.
Cool.
And 5 million is not.
Can we share the list? I'm just kidding.
5 million.
Can we get the
we can talk
list of all these
after
impact investors? You know, I mean, come on, we gotta share, right? The list.
Well, you know, the problem
kidding.
is, like, you can have a list, but they don't always answer your calls or emails. And, you know, sometimes they want, like, they don't know how to vet. Like, they get like 50 pitches every week, and they sort of rely on other people to do some of the initial screening and things. But you know, there are some people on this call today that I'm sure would be eager to help out. So
I'm not raising my hand to help out, but I just wanted to ask somebody who's begun to think about these things. I just wanted to say that I think one of the things that's needed is more education and help for people in understanding sort of what they're doing, what level of risk they're taking, because like I was on the crowdfunding platform looking at Drivers Co-op, and I remember just being completely overwhelmed by all of the stuff that it was telling me about my investment. And I was sort of like, oh, I have no idea right now, you know, is this something I'm in a position to do or not? You know, I mean, it's as simple when Dan says, well, just be comfortable with losing your money. That's okay. But you know, we're all in different circumstances, and you know, different ages, and how much you can risk and not risk, depending on your retirement situation and things like that. So, but I would put out a call for our community to try to help people who are not very financially minded, at least become comfortable with the language and the opportunities and you know what it all is about. Like a lot of us have just said, I'm giving that to somebody else because I just don't understand it. And then we're not that happy with what they do with our money. But taking control over it is I think a level of sort of commitment to the movement, but also of kind of an understanding of financing that people have tried to make harder and more complex than the average person is really, you know, understands the interest on their checking account or whatever.
Yeah.
You know, you're totally right. And I think there's also a tendency to want like a quick fix too. Like, just give me a list, you know, of just tell me who the good guys are and the bad guys, and the good women and the bad women. It's like, you know, there's a lot of shades of gray, and there aren't perfect companies, and the revolution hasn't happened. So we're dealing with, you know, a lot of compromises too. And you know, a lot of it depends on your personal circumstances, and like you were saying, so it does require like actual education and time. Jenny Casson, an amazing lawyer who helped sort of launch crowdfunding and helped write some of the regulations, and has helped a ton of companies, and I've worked with her out in California. She has a beautiful group. I'm blanking on the name, but if you go just Google her name and her website.
Crowdfund Main Street.
Yes. So she has a group that meets once a month. I think there's like a small buy-in fee that's really nominal. And then the commitment is that you put in $500 a year to some company that you love. And it's not through them. They're not brokers, but they sit there and they get 2 or 3 companies that Jenny's been working with that are open to unaccredited investors, talk about what they're doing and go back and forth with people. It's not like people don't pool their money and invest, but it's actually a great learning tool to like hear the struggles of these companies. Like, how hard is it to build this ethical company? And you know, how they're struggling with capital, and you hear like these personal stories from the real people, and you know, hearing a bunch of them, you know, like Slow Money was sort of going that route, but they I don't know, my personal take was they were a lot better with the slow part than the money. With the group up in Maine was doing tremendous things, but they've finally like closed down. But there's a big value in being a part of these groups, you know, CHIMA and the other like community funds, where you can hear stories over and over, and you start getting a better sense of, you know, these people are for real, and these people are, you know, selling me a bill of goods. And if you sort of say, okay, no, I can't risk my whole net worth, but you know, here's a chunk, and I'm willing to do something cool with it. I can guarantee that you'll just be a lot more engaged and just feel a lot better about that money than about anything else that you've invested in. And it's worth it. And so part of it is like, try a few things, and you'll learn stuff, and you'll bring other people in. But this is how we're growing.
Dan, we're almost out of time. I don't know if it's possible that you could give us a quick thumbnail of the Downtown Crenshaw project and what happened. Also what you learned from it, if there's some lessons.
Sure. So, oh boy, the 90-second version. So
this is a huge thing. This is a big thing.
Yeah. So basically, it's been the last year of my life, and I have a couple of phone calls when I get off of this. So there is, you know, the heart of Black LA, basically the Crenshaw neighborhood in Los Angeles is sort of the Harlem of the West Coast and South Central. Been through so much, disinvested, but strong in so many social relations. There was this huge property there, the Crenshaw Mall, the only mall in serving this huge population, with about 40 acres of undeveloped property. And this is because of gentrification is just out of control. Housing prices are just, you know, astronomical. And these public pension funds that own the property decided to sell it, used a subsidiary of Deutsche Bank to manage the sale. And a year ago, or a year and a half ago, they were trying to sell it to some nasty developers who just wanted to build luxury housing and basically accelerate gentrification. The community was organized in a lot of different ways, came together, killed the sale a couple of times to a couple of different developers, then decided they wanted to buy it and turn it into like a national showcase for solidarity economics. Put the whole thing under a community land trust, build tons of affordable housing, actually affordable to the local population, co-op businesses, green spaces, business incubators, the whole works. But they didn't have the resources. They had about $60,000 and the going rate was 110 million. Mm-hmm. During one of the bidding processes, so they helped bring me in, we ended up raising about $34 million entirely in philanthropy, which for a big real estate deal, that's really enough to be able to bring in banks and other institutional lenders to finance the rest. We had the highest bid. They ended up selling it to someone with a lower bid who put in less money, backed by some actually Ukrainian Russian plutocrat with a horrible development plan, and totally ignored the Black community. The group is still working to kind of stop the bad plans, but we were able to keep the majority of the funds that were donated to us and basically switch gears to buying up small single-family homes, turning them into duplexes, building granny flats, ADUs in the back, turning them into 3-family homes, properties where each one is actually affordable, usually for less than the rent people are paying, but it's off the speculative market. So it's under a community land trust, and so people can generate equity in the homes, but they're not going to sell it for twice what they paid for it. Wow. And so it's permanently affordable. And so what's all these things have been tried in other places and done successfully in a lot of places, but it was the scale was just the big differential. And the group has dreams of thousands of properties taken off the speculative market every year and put under community control. So that's still going on, and it's inspired other groups like Local Code Kansas City and hopefully groups around the country.
Wow, well, amazing. Great stuff. By the way, don't forget to save the chat. Some great info in the chat, email addresses, follow-up stuff. What a great conversation. Thank you, Dan. Thank you, Julia.
Well, thanks to all of you for spending your lunch hour or late breakfast with us.
Large subject.
Thank you. I'm so happy with the invitation. And just based on the last answer and the people we have here, I would suggest a future gathering about housing cooperatives, community land trusts, and how the solidarity economy can fight gentrification. And we have here Julia, Curry, and Suzanne, and we have other people that I think would be great to this conversation. So here's my suggestion for future topics.
Lovely, that's good.
And please feel free to reach out to me. I'd love to follow up with anyone on this call.
Thank you, Dan. It was very, very interesting, very inspiring, especially with everything happening today. And I appreciate the presence of everybody. And as I mentioned in the chat, we are opening these reader editor circles in our newsletters so we can be closer, communicate, and we accept suggestions and questions. So please feel free to join, to be actively working with our community.
Great. And if you're enjoying the newsletter, please forward it, share it with some friends, and we'll keep building it up, Thank you all, everybody. Great to see you.
Thank you.
We'll be in touch.
Thanks so much.
Bye-bye.
Hello. Bye-bye.
Bye-bye.